Hi, thanks for watching. I'm going to do a quick overview of how to watch the bond market as a retail trader. This is important for me because fixed income, rates, bonds are some of the most gate-kept concepts in finance. You'll hear retail traders talk about S&P at 7,000, NASDAQ at this, Bitcoin, but when you look at that, those are sometimes second, third, or fourth order from the primary economy, which is kind of energy, industrialization, and government rates. And it's not just it's being quote unquote kept hidden, it's actually a very complex subject. So this video, I'm just going to give a quick overview of how I believe you can simplify it so it can be more easy, honest, and accessible if you want to do a quick rates review. And this is really important if you're somebody who wants to invest in government bonds or if you want to understand the primary drivers behind equities. So the first screen I have right here, which I consider really important, is watch each contract in the yield curve. We start with the ZT. This is the 2, ZF is the 5, ZN is it's roughly kind of an 8-9 year, even though it's a 10 year with our current dynamics. This is the TN, which is like a 10 or 11 year. I kind of cover in my other videos the cheapest to deliver basket, but that's kind of more along the line of how far out they target. ZB is roughly your 20, 22 year, and Ultra Bond, that's kind of targeting those near the run, on the run 30 years. And what's really important is don't just look at, you can see there's a general trend, rates down, rates down, rates down. Look at how rates are behaving. Is the 2 year getting slammed relative to the 30 year? If 2 years are selling off faster than the 30 years, and you see this confirmed by the rates, that's a trade called a bear steepener. If you see the 5 year rallying harder than the 20 year, that's a trade called a bull flattener. And learning the terms, steepener generally means, if we think in terms of the price action of the bonds, when the short end, these two contracts are selling off more relative to the long end, these back two contracts. A flattener is when these are not experiencing as much selling, or they're getting bought more. And this is the rates themselves. A great way to watch intraday rates is the Chicago Board of Options Exchange interest rate index, IRX, FVX, TNX, and TYX. This is the bill yield, so this is not to be confused with SOFR. This is the 13-week bill yield. This is the 5-year yield, 10-year, and 30-year. And you want to watch the rate spreads as well. The big three is 5, 10, and 30 to the bill yield, and that shows the slope of the curve all the way here. So you can see we've had steepeners on these 30-minute charts quite recently, and that's the front end steepened more than the whole curve. This is a bill to 30 year, so you can see it's a steepener on the front end, so this could be a sign that this is a repo-led bear steepener trade. And finally, this chart is the 30 minus 5, and this is the shape of the curve outside of kind of that front end, which is very sensitive to Fed policy. And what you see here is there's actually been a flattener. So this is a very interesting regime that you can access with Thinkorswim or any retail available platform like TradingView. You can see there is a front end steepener happening, but a duration flattener, and that is some economists might not actually call that a good sign for the whole economy. The next thing you want to watch is the dollar index. I'm using 30-minute charts for all of this. The dollar index is heavily tied if you want to start thinking about SOFR, repo rates, and things of that nature. The dollar index is kind of like a global reflection of the dollar's funding strength on other currencies. So when the dollar rallies, as we have here, that is the American repo ideally strengthening on others. Now there's rush on liquidity that happens on different circumstances, so it's not a perfect, there's still market dynamics, but you can kind of see that front end steepener is also a strengthening dollar, or the US funding rates strengthening on international currencies. And finally, credit. Credit's a really difficult subject because there's so much going on. It's almost like saying the stock market, when that's just so massive, you can't really define it by one thing. But I would kind of say this is your S&P 500 of credit, which is the iBox investment grade minus high yield, which roughly gives you a retail available watch on credit spreads. So you can see credit spreads have been widening a bit. They've been calming back down. And why this is important is when credit spreads widen, as shown by this, corporate lending, which directly moves into the stock market, is more difficult. That's a tight regime. When credit spreads kind of close back in, that's more loose money. So you might even see startups, venture capital having easier access. And the final product I want to show is the SOFR curve, which this is one of the most important things if you want to understand how finance works. This is repo, and in my other project videos and educational videos, I explain just how important repo is. It impacts the futures markets, it impacts probabilities pricing, but right now with our current regime, this is technically the dollar funding rate, and this is the SR1 contract, Chicago Mercantile Exchange contract, and as you can see here, we have the contract going down. This actually means rates are going up. This is an IMM index, so it's 100 minus the rate. So you can see SOFR, the spot for this month is around 96.36. By January of next year, it's all the way at 96.06. That's about a 30 basis point up movement being projected by the curve. Some could call that rate hikes, some could call that just energy driven inflation, but whatever the case is, the futures market is predicting the front end of the rates set by the Federal Reserve to be increasing, which is really interesting because only right before the Iran situation, months before, this was actually sharply up. There was a lot of Fed cut expectations happening. So you had an interesting regime change happen where the economy thought it needed cuts from the Fed, but energy is making it where hikes might actually be the equation. So this could be a 70s situation where the economy needs cuts to protect itself, but energy won't let those happen. And that's just my quick overview. And whenever you start trading futures, you would probably want to start doing things like this. We'll look at ZN contract, and this is the June, and this is the September. You don't want to be doing active trader stuff, VWAP, influencer trading. You want to be looking at what do you believe the fair value of a contract is? How's it being priced out in time? There's a lot more nuance there, and there's a lot more institutional trades. If you get caught up trying to chase price action on contracts, you're probably just going to end up becoming another retail trader, and it's becoming a secondhand gambling addiction. And that's just what I wanted to show about how to do a general bonds overview. I want to make sure it's not overwhelming and you can get the fundamentals. Ultimately, if you can see how the price of the bonds are trading, understand the rates, see credit in the dollar, and finally look at the curve of repo, you can get a really good global perspective on rates that frankly gives you a massive advantage in equities investing, fixed income investing, even corporate bonds if you want to add that to your portfolio. Thanks for watching, and that was just my quick overview.